Moving on to markets now, and the latest crop progress report shows the Midwest harvest progress fell off a bit due to widespread rainfall. Overall, corn harvest was up a few points to 74% nationwide, down from last year, but still ahead of the 5-year average. Meanwhile, soybean harvest is reportedly at 79% complete, falling short of last year's total to this point, as well as the 5-year average. I was joined earlier in the week to discuss those numbers and more with Tredas' Doug Simon. So let's get started here by talking about the latest crop progress report. It looked like things were slightly behind with corn and soybeans. Can I kind of get your take there?
Well, they had a little bit of rain this last week. We had much, 5 inches in Lincoln, and so it's been a little wet around here. And the actual beans have been a little bit tougher because the beans have dried down, but they've been, all the stems and everything's slow, so it's been a little bit tougher to get going. Seems like dews have been staying around, so maybe a little bit slow. You know, we're about 79% done and average about 81%. So we're a couple points behind on that. Corn, we're actually ahead of average, so and we're a little bit ahead of or behind last year, which, you know, it was drier, so things moved along pretty good. But, you know, corn's moving along, so everything's moving along pretty well right now. Doing a good job.
Excellent. So Monday it appeared that corn futures were trending upward while soybean futures were down slightly. In your opinion, what are some of the factors that are driving those price movements?
There's a lot of, I would call cost push inflation going right now with things going on in oil market that's kind of left over from COVID. Our rig counts in the U.S. are about 50% of what they were pre-COVID, like the Baker Hughes rig counts, so number of oil rigs. And that's partly a function of COVID and demand, but it's also partly because of change administrations and different policies, I think, on oil and carbon. And if you look at worldwide, we're still about 60% of what those were 3 years ago. So we've got, every day it seems like higher oil prices or nat gas prices. They've been pretty volatile this last week, but when you look at that, that's also pushing fertilizer prices higher. We're like we were in 2008 when oil went to 150 and fertilizer went up to about 1,100, bucks a ton. And we're in that same range right now. So we've had a massive increase in fertilizer costs. So we've kind of got a demand pull from the ethanol side is really good ethanol margins. We've got low stocks on ethanol, high price on ethanol. Margins are great, so they're bidding up from the farm side, from those ethanol producers. On the export side are okay. They're not great. But the big thing is, I think, also looking into next year is that with those higher anhydrous prices, people are wondering, okay, am I going to pay up for that? Because people locked in stuff back in August, it was like $750 a ton, and now it's gone up to $1,100 a ton, so that's a big move. So people are starting to say, hey, am I going to plant more corn, or am I going to move over to beans? And that's kind of a big picture thing that's driving prices right now. So
moving over to wheat, planning's probably just getting pretty close to wrapped up, and futures were ending 22 cents higher at the beginning of the week. Can I get your thoughts there?
Well, we've had a dry year this last year up in the north, in the Dakotas, and down parts of Texas, Montana. So we've been dry. So we've got just a lower crop, probably up in some of those spring wheat areas. And so when you look at Kansas City wheat and Chicago wheat, there for July of 22, they're both on par, right just under $8. And the spring wheat up in Minneapolis, which is a harder wheat that they use in a lot of bread and pasta and bagels, things like that, is less supply, and so their prices are up at $10.50. So we've actually kind of got a market now where we're paying more for protein up in those spring wheats, and also Kansas City typically trades at a premium to the Chicago wheat, which is a soft wheat that goes into biscuits and things of that nature. So we've actually got them on par, and typically we do pay more for premium because that's what's the most kind of precious thing in wheat is the premium, or is the protein.
And before we wrap things up here, do you have any marketing risk management advice or strategies that you'd like to share with the viewers?
Well, going back and talking about those fertilizer prices, and you look at, people are probably going to pay another $60 an acre for just nitrogen costs this year. We've also had other fertilizers that have gone up, largely because of some of the kinks in the economy from COVID. Nat gas prices, there's a big, massive inverse there. Nearby nat gas prices are higher, partly because of COVID, kind of kinks in the economy, but also because of the stuff that was going down in Louisiana in the Gulf. So you've got those issues on the cost plus or push side of it. So right now you've got next year's price at $5.50 roughly. Nearby prices were $5.80 today on Tuesday. New crop beans and old crop beans are both in that kind of $12.50 level. So when you look at that kind of soybean to corn ratio, even though those costs are gone up quite a bit, you still need to be, and where they were earlier when people were able to lock in anhydrous, and like in the eastern side of the state, we were more 750 when they were offering that out back in August. And you look at those break evens, I've been looking at, okay, how much new crop corn do we want to sell here to kind of protect that anhydrous cost that we have already locked in, and take advantage of those. Because what happened in 2008 when anhydrous went to $1,100, that following spring it fell off. Not only did oil go from 150 bucks back to 30, anhydrous had a massive collapse too, but corn price also went from 8 back to 3. So we're in an economy where there's a lot of, I think, anxiety and a lot of, just a lot of dislocation and things like that. So it looks like corn prices, should remain high, but we also have, with additional, probably more bean acres next year because of those input prices. We'll see more beans planted, more wheat acres being planted because of the price where that is relative to cost. Corn acres could fall a little bit, but you're still going to see growing stocks between here and next year, assuming we don't have a big, it's a long way to look out in terms of what those yields are going to be. But if you've got 550 corn and 1250 beans, those are profitable numbers right now. If you go and look at Farm Docket from University of Illinois, they're looking at different cost of productions. They've got some really good things they've released here in the last several weeks. Go look at those things and look at cost, kind of returns. Those things, I think, give you some, even though those costs of inputs have gone up, there's still, if you look at those net returns relative to where we've been the last several years, 550 corn is still a good price. 1250 beans are still a good price. So you have to kind of get in your head. We're always looking ahead, trying to sell. I think you need to be asking about that. And then our yields have been phenomenal in Nebraska. You've got to make sure that you're up to snuff on what you've got sold for 2021 crop as well at these prices. And the basis levels are fantastic as well too right now. Actually, bean basis in Lincoln improved about 22 cents here in the last week as they rolled to the Jan. And ADM Columbus is 2 over good basis levels there, and out west the basis are even better than that. So there's just a lot of good things right now going on in agriculture. The input prices are higher, but the nets are still good relative to where we've been.